Welcome to the weekly update, where I'll go over the action in the market for the week of October 20th through the 24th, and we'll see how things look for the week of October 27th through the 31st. Okay, had another up week, turning a bit more on the offense or risk on, if you prefer that statement. Now, it looked like Wednesday we were getting a little bit more defensive. Even with the government shutdown, earnings are really what's driving things, and there's optimism about some kind of a deal between the US and China, and the market is liking that. Plus, we're staying positive in the bigger picture. And so it looked like maybe things were switching over on Wednesday, but then Thursday and Friday we had pretty good up days. CPI came out. Even though the government still shut down, they did come out with that report, and the market liked it. So we ended up seeing some pretty nice gains there. So for the week, we were up 1.92% on above average volume. Now, one thing to be aware of on Thursday and Friday, we had pretty solid up days, but we were below average with volume on both of those days. So just something to keep in the back of your mind. What we like is when we see an upward move, we would like to see volume also pick up. And it didn't do that. So, but as always, there's things to be concerned about, but we'll go through and look at the charts here. We are positive for the most part. We're seeing growth coming back in, starting to reestablish itself in the bigger picture. After trying to get somewhat defensive, it's still kind of defensive on the daily side, but it's looking a little bit better in the bigger picture when we look at it on the weekly charts. And interest rates, we're at 4% with the 10-year yield. So that's been coming down. Now, a week ago when I did this video, we were going with interest rates going down and stocks were going down. And that was more of a flight to safety, similar to what we saw last spring. Well, we continued to drop with the 10-year yield, but it was much more subdued. It seemed more orderly. And we even saw that when stocks were going up. So maybe that's calmed down a little bit, but with all these things going on, all these geopolitical events, all these domestic things happening in the US, we just want to be careful because news can come out that contradicts what we think the market is going to do, and then it kind of rattles things. Plus, in the upcoming week, we should be getting an announcement from the Fed, and it's pretty much a done deal that they're going to cut rates 0.25% there. So earnings have been really driving things up. Now, Wednesday didn't see a really good day for earnings, but Thursday and Friday, yeah. And we've got the big guys that are going to be reporting in the upcoming week as well. And there'll be some Fed speak. There'll be the Fed making their announcement, and then the press conference, and then how the market takes all of that. Okay. And as far as the trend, we're finally starting to turn up. Now, it's not a confirmed trend, but we're coming above the moving average, but we're still below 20, but it's positive with the green line above the red line. So for the week, the Dow was up 2.2%. It set an all-time high on Friday. And the NASDAQ also setting a new all-time high, up 2.3%. The S&P all-time high, up 1.9%. Now, the small caps still have a ways to go, but they were up 2.5%. This is a little bit more risk on. It's like, okay, well, interest rates are coming down. Maybe I'm already set up with some of the large caps. Let's go be a little more adventurous with some small cap stocks. All right, so just some bullet points. The stock market built on last week's rebound and had another broad advance as investors rotated back into equities following the prior pullback. Really, they're going back to October 10th when we had that big down day, but we've been range bound ever since then on the daily side. Well, Friday, we finally broke above that range that we've been in. And we had a soft CPI that came out, and this reinforced the expectation that the Fed's going to cut rates in the upcoming week, and then likely again in December. This also pushed the major averages up to closing highs on Friday. Leadership was broad, but it tilted toward growth-oriented and economically sensitive groups. Economically sensitive, that means when the economy's doing good, these stocks do well. And the economy seems to be doing good, despite the shutdown, despite all the crazy stuff going on in the world. From a stock market perspective, things seem to be looking good as of right now, but that can always change. We have to always be ready. So earnings, they added to this positive backdrop that we've been seeing. Several large cap companies delivered better than expected results, And then not only with the results, but then how does it look going forward from here? And that's called guidance that reinforced confidence in the corporate profitability heading into year end. And we're also coming into a positive seasonal time as well. So, trade related headlines, this has to do with US and China mainly. It contributed to some midweek volatility. That was on Wednesday after mixed signals between US and Chinese officials. Apparently, Trump's going to be going to Asia in the upcoming week, and maybe they'll be able to hammer out some deals there, not only with China, but other countries as well. Though the markets ultimately look past this by the time we got to the end of the week. Defensive sectors did lag. Staples were down, energy was down, and this suggests a more risk on type of tone for the market. So, overall, the week's gains reflected a continuation of a post pullback. That's going back to October 10th, when we actually dropped down below the 20-day moving average. And so we're seeing momentum now building up a little bit from that with improving earnings sentiment and tempered trade concerns to sustain the market's upward bias. Can you tell I didn't write this part? I usually like to put this in my own words, but I wanted to get this recorded quickly. So I just kind of copied and pasted from briefing.com ahead of next week's mega cap earnings. All right. So just want to keep this in mind here. We did get CPI. That's one of the big inflation reports. Seems to be under control. So it's not down to the 2% level that the Fed wants. We're closer to the 3% area, a little bit above that, but we're still in the lower end of things here. But just remember, things can and do change like they did back in the mid to late 70s. So we're actually below the 4.02% level. This is when the market tends to do better, when interest rates are coming down. This has not been updated. We still have not received the employment report here. This hasn't been updated. But then looking at earnings, are the Magnificent Seven companies still top contributors to earnings growth for the third quarter? That's what we're in right now. And if you look at these charts, the takeaway is yes, they still contribute much of the power behind the stock market. And then the update as of Friday, 29% of S&P 500 companies have now reported. Still a long ways to go through earnings season. And of these companies, 87% of those that reported had actual above estimate earnings. And they do that. They lowball it. They're hoping to get a bit of a pop out of it. And that's why lately the earnings season has been taken as positive. Okay, so here's the chart. But going back to Monday, we did gap up into Monday's session, but we were able to hold on to the gains. So we were looking a little bit better. And then we were okay, not seeing an awful lot of movement here. Then things took a bit of a turn. Now, it didn't gap down on Wednesday. We saw the selling. This is when news came out after the market opened. We actually came all the way down here to S3. But the thing that was encouraging here is that we saw some late day buying coming in. And then for the most part, that carried over into Thursday, and we closed just a little bit off of the high on Thursday. Then CPI came out. The market liked that. We gapped up. So most of the gains was seen from the gap there because we just kind of drifted. So, but on the positive side, we were able to hang on to the gains going into the close on Friday. So for the week, all of the indexes ended up being up, with the small caps being up the most. NYSE was up, but it was up the least. And second to last was the S&P. But again, this is just the 5 trading days. This isn't Friday to Friday. It's Monday through Friday. So going back to the beginning of the year, we still have the NASDAQ 100, NASDAQ, and S&P. They're still the 3 strongest indexes, but all of the indexes are positive. The sectors, we had an up week with tech. That's the big growth area. Now, energy, it took a bit of a hit on Friday, so it gave back some of its gains, but because of things that are going on geopolitically and sanctions that are being put on some Russian oil companies, that really bumped up the price of oil. But it did fall back a bit on Friday. It was still up, one of the stronger areas here. Industrials too, that's more economic. Healthcare is seeing a bit of love lately. The financial sector still underperforming the S&P on the daily side, but improving as well. So the only sectors that ended up being down were utilities and staples, and these tend to be more defensive overall. So we like that. It's more positive when these areas underperform, unless you own some of these stocks in there. Okay, then going back over to the scooter score, we still have the tech sector coming in the strongest at 93.6. Then a distant second are utilities, communication. The weaker areas would be materials, energy, and staples, which again, these, especially the bottom two here, tend to be more defensive in nature. And so the fact that they're underperforming, that's okay with us unless you got into them and now you're seeing losses. All right, so the 5 trading days for the sectors, we had tech up the most. Energy, again, it gave a lot of the gains back on Friday, but it was still up on the week. And then the rest of them ended up being flat to slightly down with staples and communication took a bit of a hit just for the trading week. But going back to the beginning of the year, we see tech and then utilities, communication. We'd like to see discretionary doing better, and it has moments when it does, but then it seems to be falling back. That's another pseudo growth area that we would like to see performing better. But we see staples in energy. They're the worst performing areas year to date. So an awful lot of green here, especially in the big tech areas. This is all growth. And then communication. Now, Netflix got hit pretty hard. Their earnings report was not well received. Apparently, they need to get some better movies or something. Where Amazon was up, Tesla ended up being down. And then a lot of red in these more defensive areas as well. So looking at the relative rotation graph, this is just for the sectors here. We're still coming down a little bit with communication. That's a growth area, but we're still green here. And then we have discretionary, which is also turning down. We would like these to be going up and to the right. They're actually going down a little bit, but they're still in the strong area, but they are pulling back. Where we're seeing a bit of a move up here with healthcare, energy, and utilities. They've been improving, and then these other areas have just kind of been floundering around if you just look over the last year. So we have discretionary and communication. They're the stronger areas, but even they're showing some weakness. You can see the changes that we saw here. And then more neutral would be tech, and then the negative areas are in red, with the improving areas down here in blue. And we look at the indexes, we still have the S&P just kind of floating down a little bit here over the last year. Not as strong as it has been, but hey, we're setting all-time highs. But we're still lacking that real strong conviction that's looking solid from day after day after day. We haven't really been seeing that. And even after Friday, we're still getting a bit of a mixed picture on the daily side with the S&P. We're seeing a little bit of a pullback with the S&P 100. Those are the big stocks that make up the S&P 500. Bit of a pullback here, weakness with the NASDAQ 100. Seeing the Dow Jones Composite and the mid caps showing some improvement, but you'd never know that by looking at the mid cap chart. It's just been chopping around. It had a pretty good day on Friday, where utilities are trying to improve here and transports are really lagging behind. So we have the S&P 100 and NASDAQ 100 showing some weakness, but they're more neutral right now, where we're seeing a little bit of weakness in the S&P. Again, this goes over the last year, not just the last week or couple of months, and a little bit of weakness with the utilities and transports, where we're seeing some improvement with the small caps, mid caps, and Dow Jones Composite. All right, sentiment. The latest reading from Investors Intelligence, still above 3, coming in at 3.5 right now. It could go higher than where we're at here, but when we get above 3, it's like, uh-oh, maybe folks are getting a little too happy about things. But we're still negative as far as sentiment. Now we're improving. We got all the way down to like 23. We got extreme negative there for a while, but we have been coming back up when we look at the chart here. See how we were coming down here, and then we are improving. But we need to see more follow through, and we need to see more exuberance happening here and possibly get us above the 50 level and continue to go up. But it had been actually showing some weakness here. Now it seems to be improving as far as sentiment. And the active asset managers coming in just a little bit above this red line, 90.35. Now, this could still go higher, but this is when it looks like maybe they're getting a little too happy with this as well. Now, this is before Thursday and Friday's advance, is when this data is actually released. So it's likely to go up even more in the next reading. So 90.35, we start paying a little bit more attention to it when it gets above 90. We really pay attention if it goes up over 100. And we're coming down with the VIX. We're below 20, both with the line chart and the bar chart. So that's been more positive for the market. We haven't really been following the seasonal patterns with the VIX. It usually goes up in August, September, and into October. We've just kind of been floating around. Then we had that big down day, and the VIX really spiked up. Now it's been starting to come back down, but this chart hasn't been updated in a few days. Still looking good here. When the black line is going down, that means tech is outperforming cash. That's a positive market. And still getting a pretty high reading with the RIDEX bear bull ratio. When we get low readings, that means folks are more bullish than bearish. And we actually saw a bit of a drop here with individual investors. They were slightly positive. Now they're dropping down to slightly negative again. And that could actually work in the market's favor until these folks get really exuberant up to the 30 and even 40 level. That's when they're like, okay, get me in at all costs. I'm afraid of missing out on things. Well, we're not there yet with this sentiment gauge. Now, on the daily side, we're above the moving average with the Ulcer Index. That's showing us still that there's an increase in fear on the daily side. Here on the weekly side, it's pretty comatose. And then we look at the spread between risky and not as risky bonds. This tells a little bit more story. We were getting a little bit more fearful here, but now this is starting to go up. That means there's less fear in the bond market. And we're still going up here, though. I stopped showing this in the daily videos because this is a long-term chart, the VIX. And then we look at a 3-month average of the VIX and do a ratio. When this was going down, that's when the S&P was going up. Now, this is still going up, but it's going to take a while for this to shift. If this starts to roll over and come down, now that the VIX is dropping, that would be more positive for the market. We're still positive here with the long-term equity put call ratio. That's continuing to decline, which is positive. Then the weekly economic index here, not really any change that way. We're still below the black line with the Chicago National Financial Conditions Index. That's looking okay. Still coming in just a little bit under 4% with the latest reading for GDP now. So this is looking pretty solid. We had that negative quarter back in the first quarter of 2025. It looks like we're coming back now. And then the New York Fed staff still coming in at 2.25. So they're a little more conservative with what they see happening with GDP. This was not updated until we get the employment report. Same with this chart. We just have to wait here. This also hasn't been updated. A lot of this is due to the government shutdown. So saw a little bit of a gyration around here in Friday's session because we finally had CPI coming out here, but the market took that as friendly. So we're going to have the Fed coming out. There's a 98.3% chance that they're going to cut rates by 25 basis points or a quarter of a percent when they make their announcement on Wednesday. That's not the surprise. The market's already figured that in. You can see on the next side here. That's what the market thinks right now, day ago, week ago, month ago. It's what are they going to say? That's what is kind of the variable. And then we look out to the December meeting, 91.1% chance that they're going to cut rates another 25 basis points at that meeting as well, and pretty much getting more locked into that idea at the same time. The market's pretty much counting on that. What we're watching for is the scenario going to be challenged to take this away. The market's okay with this. It likes that interest rates are coming down, but the economy is still doing quite well. If that starts to shift one way or another, that could change this whole positive backdrop that we've been seeing. So still seeing a long-term decline of the Fed balance sheet here, a little bit of an increase when we look at it on a year-over-year basis here. Not really seeing much of a change here with the overnight reverse repurchase agreement. So nothing really strange happening there right now. Looking good here, setting an all-time high with the advanced decline line based on price and volume. So can't get much more positive than that. We're improving here. We saw a nice lot of new highs here and a bit of a contraction of the new lows, but we really haven't started to go up with our 4-week moving average, and we're still going down with the 10-week moving average. And we actually came down a little bit here, but we're still above zero with the short and intermediate term advanced decline ratio. The trend, we're finally starting to move above the moving average. So that shows a strengthening trend, but it's not a confirmed trend until we come back and cross above 20. But it's positive because the green line is above the red line, and we see the green line going up as the red line's going down. So that's positive. And we just switched over to looking positive on the daily side, but we're under 20 in the short term. That means we're not trending right now. So we'll have to see. Is this going to be the ramp up to a nice little positive trend? That's kind of what's in the background right now. We're also looking quite positive here with the Arun. The greens at the top, those are buyers. The reds at the bottom, those are sellers. Longer term, the buyers are in control. Not getting a signal here. Now we're almost getting a signal on the daily side. I don't put an awful lot of weight into these mass index signals. It tries to suggest there'll be a reversal, but we need other charts. We don't want to make decisions just based on one chart that we see with this. Long term, okay, so we're still looking good here, setting an all-time high. Now on the daily side, you notice how we topped out right at this pivot point. That is currently acting as overhead resistance. So we want to see if the S&P is able to get above that. And then we have the pivot points already on the chart now when we start to look into November. And looking good here. 50-week moving average. That's the red line. Price is above that, going up, looking solid. In an uptrend here with the moving average crossover, looking pretty positive there. We were up 1.92%, so we're still seeing this longer term higher highs, higher lows when we look at the weekly bars, and that is positive. And we're kind of getting near the upper end of the trend channel. Now, I don't put as much weight into this. I think horizontal lines are more powerful than slanting lines, but we still want to keep an eye on this. This might mean that we are possibly getting a little overextended. We did that before back in 2014, and then we did it back in 2021. So it doesn't mean we have to stop here. It just means we just need to keep an eye on this. All right, now looking at the smart money indicators, positive here on the weekly side. Accumulation distribution is positive. We're positive with the boom indicator. Now you could make a little bit of a concern by seeing that we're above this red line. Okay, so just something to be aware of there. And we're actually still declining. And this is what's strange. On the daily side, we're declining with the Chaikin money flow after Friday's advance because we were below average with volume. So we're not seeing a lot of smart money coming in and doing a lot of buying. And that's showing up here on the weekly side as well. So just something to be aware of there. Always something to be concerned about. We are turning back up, but we haven't quite crossed back above the moving average with the weekly chart of the Chaikin oscillator. But we are positive with the vortex. Now, the vortex on the daily side, it's like bouncing around. It's like popcorn all over the place. We have an up day, it goes positive. We have a down day, it goes negative. Usually when you see a cross here, they tend to stay that way for a while. We're not seeing that on the daily charts currently. We are above zero and going up with the McClellan oscillator. So we're going up with the summation index based on price and volume. That's longer term positive. And we did finally see a bit of a bounce with the bullish percent index. We actually dropped below 50 a week ago. Now we're starting to come back up. And this is showing a strength, buy signals on the point and figure chart coming back into the S&P. We want to see this continue to go up if price continues to go up as well. We're above zero and going up with the swollen trading oscillator based on price and volume, getting a mixed picture now on the daily side. And momentum still looking good in the intermediate term with the PMO. We're above zero based on price and volume. Both of these are also above their moving averages. So an improvement here with the PMOs that are rising, also improving with the buy signals and starting to turn back up with the PMOs that are above zero. All right, and we're above the midpoint and going up, but not extreme with the percent B indicator. We're still below the upper Bollinger Band, so we haven't been going up too far too fast. So getting a mixed picture here in the short term. The slope oscillator is going down as the other short-term oscillator, the TSI, it's continuing to go up and actually rolling over a little bit. Now, we were seeing a bit of a rollover here with our three intermediate term oscillators, the MACD, the PMO, and PPO. So we'll see if they can turn and start to go back up. They're also giving pretty high readings. Like the slope oscillator, it could only almost go down. It was giving such a high reading here. So we'll watch this and see if that comes into play. Where longer term, we're still going up, but we're getting extreme readings with the tricks in KST. Still negative though with the Copic curve. It's kind of its own thinking little momentum oscillator there. Positive with the force index. Starting to get extreme, but looking positive with the money flow. And we had another up week with the rate of change chart, but we actually declined a little bit when we go back 50 weeks. So not a major concern here, but you would have expected this to go up. And some of our longer term moving average studies that we do based on 100 and 200 periods actually declined on Friday, even though we went up with the S&P. A little strange. Not what you would expect. But we're still looking positive here with the RSI above 50 and advancing. And finally seeing some improvement here with the Stochk RSI. We're not seeing an extreme reading on the daily side, but it is turning more positive. We're back to seeing longer term positive momentum with the Williams percent R. And we're going back up above 50 with the ultimate oscillator. We're still looking good with the weekly special K chart. That's long term. And I didn't change this because who knows if we've actually finished setting highs for right now. We only pay attention to this if we really start screaming down and we start hitting these moving averages. And then when I adjust this, if we start hitting these Fibonacci retracement levels. So we're looking good here longer term with the Heikin-Ashi trend. We're positive with the Kagi trend, positive with the Renko, positive with the three-line break. we're turning back and looking more positive on the daily side. We spent a lot of time chopping around within October 10th's high and low range. We finally broke out on Friday, and now the charts are starting to see that. We did get some new X's drawn in here on the weekly chart, the point and figure chart, ascending triple top breakout that was generated back on the 20th. So things are looking a little better there longer term. We're still positive with the ease of movement. We're still negative on the daily side, though, and looking pretty good here with the long term. Actually, pretty flat here with the intermediate term, coming up a little bit flat here with the short term momentum here, but we're positive. After spending 4 weeks neutral with the Elder's Impulse system, we finally broke out and we're now green again. And we're positive with the parabolic SAR weekly chart. We're also positive again on the daily side. Positive on all time frames, short, intermediate, and long term with all the different stock indexes. One thing to be aware of, the dollar is trying to rebound here. That might bring gold down a little bit, but that could also pressure stocks if the dollar continues to show more strength. So setting all-time highs with the S&P, still have a ways to go with the mid caps and the small caps. Now this is the S&P 600. This is not the Russell 2000 small cap index. And the Dow setting an all-time high in an uptrend. NASDAQ all-time high in an uptrend. You're going to hear a lot of the same thing here. NASDAQ 100 looking really good. Mid caps, not really breaking out to the upside yet. And small caps still have a ways to go also. NYSE, not quite back to an all-time high here, but still looking pretty solid. All stocks, this is continuing to go up, meaning that U.S. and international stocks are outperforming. The FANG index just looks like a closing all-time high here. These are the really big stocks. They're the ones that really drive the market. ARK was also up on the week and hasn't really broken out of this range, but it's still in an uptrend. We are improving a bit here with the banks. The KBW bank index, it was up 3.62% on the week. We got back above 50 with the RSI, but we're still going down. It got hit after some earnings came out, especially with the smaller banks. Haven't really heard much more about that. So the market's kind of forgetting about that for now, but keep that tucked in the back of your mind in case there's some kind of news that a smaller bank is suddenly having some problems. In seasonality for October, we've been up 60% of the time going back to 2021 with a return of 2.7%. So the Dow setting all-time highs, not even close with the transports, just coming off of recent all-time highs with the utilities. And then just chopping along with a lazy uptrend here with the CRB index. Commodities aren't really breaking out, nor are they breaking down. We did see a bit of a bounce more for geopolitical reasons because of the sanctions put on a couple of Russian oil companies, but it did give some of that back in Friday's session. And see how the dollar longer term is trying to turn up here. We're trying to turn up on the daily side, but we've got a ways to go for this to actually start into an uptrend. The copper chart still looking pretty good. The economy's looking good. So copper is looking pretty good. And gold, it really got hammered on Friday, but it's been setting recent all-time highs. And the same thing with silver, hammered on Friday, but really nice on Thursday. Then looking at bonds and interest rates, still going up with the total bond ETF. And then the stock to bond monthly chart, this won't be official until a week from now. I'll be able to show you the completed October version of this chart. Rolling over a little bit here because bonds have been doing quite well, but they're both still doing good with stocks still outperforming. And we've been gradually coming down here with the yields in the US, and we've been going up. We're watching this 10-year yield in Japan. Doesn't seem to matter. We have been coming down here with the US, that's in green, dropping down here with UK rates. Not much of a change overall here recently with the German rates. Okay, gold still the best performing asset year to date with stocks in second place, almost neck and neck between commodities and bonds based on price. We saw oil bouncing back up. A week ago, it was the worst performing asset. Now it's back to the dollar taking last place. And then we look at some ratios. NASDAQ 100 growth to S&P, that's growth and value. Growth is outperforming. That's what you see in a solid market. S&P 100 still outperforming the S&P 500. Growth outperforming value. Gold outperforming pretty much everything right now, especially the US dollar, and also outperforming even though it pulled back on Friday and the S&P went up. That's why you're seeing this ratio coming down slightly. Bonds continue to underperform stocks longer term. Discretionary. We'd like to see this doing better, and it's not that it's doing terrible. We're seeing some strength earlier on that we're not seeing right now. We would like this ratio to keep going up to be more positive. This going down is positive for the market. The low volatility to S&P ratio, that means the market's becoming less defensive instead of more defensive. And we're still declining when we compare energy to tech long term. And small caps still have a ways to go to even get close to performing better than the tech sector. Then long term, now we have the NYC breadth thrust. This is just kind of what's happening here, not seeing anything all that much. Now, we closed the window for the ZWAG NYC breadth thrust, but we're not going to get this chart updated until Monday's close. We needed to see this go up to this red line by Friday. Now, we had a good day on Friday, but I'm not sure we had that good of a day. So if we don't get up to this red line when this chart updates, then this will fall off. So just something to keep in mind. We saw a little bit of an improvement with the Zohorchak method. We were at -6. We climbed to a -4. And still going down here. Now, this is longer term. The 50-period new highs, new lows for the S&P were well above zero. That's not the problem, is that we have been coming down a little bit here lately, and actually coming down with the NYSE new highs, new lows. Also a 50-period moving average, still hanging out well above this trend line going back to 2009 for the NASDAQ 100. Still looking really good with the NASDAQ to Dow ratio. The Qs to small caps still looking pretty solid here, and we continue to decline with the 3-month yield. And then we're still going up for the most part with the new highs and lows cumulative for the NASDAQ. Then seasonally, we are in the second half of October, which tends to perform well, but not as good as the first half. And then for October, going back to 1964, we're up 1%, 59% of the time on average. Now, there's two areas to look at here. And if you look harder, maybe I missed one, but I've been focusing on the June and November, which doesn't do all that well. It's up 3.4%, a little more than 2/3 of the time. But if you start to count the beginning of October, this turns a whole lot better. We're up 6.7% over 70% of the time. And we're going to get even better once we get into November. All right, and then the S&P for October going back to 1950, up 11 out of 18 times, down 7 out of 18 times with a return of 1.3%. And then here, just showing positive ways, whether you look back 20 years, 10 years, post-election years, since 1950, they're all positive. And then I started showing this on the daily side. November also looks pretty good as well. And this is another seasonal chart. Once we finally get through the end of October, we do see a lot more positive seasonality going into the end of the year. That's also brought out here. This was a chart I was showing on the daily side. I'm just going to keep it over here on the weekly side now. This just shows positive seasonality going into the end of the year. This also shows positive seasonality. Now, there's no guarantee with this. This just means that historically, this is what has happened. So then we have this Hindenburg-Ullman thing that's lurking in the background here. This is the criteria for it, if you're interested in that. We have not received the confirmation spike, and we have until November 7th for that to happen. So there's still a little bit of time on this. The ZWAG NYC breadth thrust, that's going to be yay or nay when we get the updated chart on Monday. This one's still going to be around for a while. The perma bears love this thing, which is probably why I ignored it for years and years. Because if they're into it and they're wrong most of the time, why should I pay attention to it? Until I found out that Stock Charts puts all the criteria together and makes it more objective in a chart, just showing you what's happening here. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.